Now, in order to understand the psychology of support and resistance, let us talk about a bullish reversal bar. And it's called a bullish reversal bar because it is a single bar that gives you a big heads up that the momentum has reversed from down to up. Let's take a look at this bullish bar. This is our bullish bar, and this is our bearish bar. We can see that our bullish bar closed above the real body of our bearish bar, and we will say it closed above the high of the real body. Remember, this is the upper shadow, this is the lower shadow, this is the real body. This is the high of the real body, which is the open, and this is the low of the real body, which is the close. So for a bear bar, the top of the real body or high of the real body is the open excuse me, and the low or bottom of the real body is the close. When we look at our bullish bar here, we see that it closed above the high of the real body of the bearish bar, and that creates support for a bullish move. Now, why does that create support for a further bullish move? And that takes us back to our psychology of support and resistance. When price closes here above the top of the real body, and even more so if it should close above the high, the extreme high of the bar altogether, but now we have a close here. If the very next bar starts to dip down, what's going to happen when the next bar dips down and gets here? Short sellers are going to start buying. This is why the full range of this bar acts as support. As price moves further and further down, you have more and more buying that is generated from the short sellers, contained mostly the herd within the real body. We can call this a stampede. So all of this buying starts to boost price back up. And when other buyers who are not in the market yet, when they see price go back up above the high of the real body on the bullish bar, now new buyers want to join in. These are the knowledgeable buyers, the buyers that actually move a market. So now you have two sets of buyers. You have the new buyers who are coming in when price goes above here, and you have these short sellers who are buyers. That's why this bar is support. It is serving as support for the up move. In case of a fall, price will typically bounce off of support. And if the next bar after this bullish bar should fall and close below the real body of this bearish bar, then the term for that is support has been broken. This is why you always want to place your stop below support, because it works just the opposite on a bearish reversal. If price should fall down and close below support, that means it also closed below the real body, the low of the real body of the bullish bar, and now you would have a bearish reversal. And this bar, the open of the bullish bar, would serve as support for a down move. It will be resistance to a further rise up, but it supports your position for a down move. And that distinction is important to understand, because resistance is overhead and support is below. But now when we're talking about your position or positioning, if you sell short below the open of this bullish bar, then this bullish bar is supporting your short position, but it is resistance to a further rise up. You should never enter a long position unless you have support below. So when you see a bullish reversal bar, now you know why it's called a bullish reversal bar, and now you know when not to enter the market. Because if this bar had not closed above the real body of this bearish bar, you would not want to enter that market, because now you would not have support below your bullish or your buy or your long position. And it works the same way in reverse. And so next we'll talk about a bearish reversal bar.